You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of EUROSTOXX, VSTOXX, DAX, and European rates derivatives like the Bund, BOBL, and SCHATZ, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody. That music means we are back once again. It is time to roll out another episode of the European Market Brief. Hard to believe we're already on episode 4. To me, this is still the new show, the brand new show, the little engine that could hitting the network, but already rolling on in to episode 4. Thanks to all of you who've been listening and downloading and streaming and subscribing and sending in your questions and comments and feedback and rating and reviewing. We appreciate all of you. You never know when you launch a new show exactly what the response will be, and we're pleased to see so many people are enjoying and engaging with the newest addition to the network. My name, of course, Mark Longo from the OptionsInsider.com, as well as from the aforementioned network upon which all of you folks are mainlining. If you're new to the network, there's a lot of great content there waiting for you, nearly a dozen other shows. So when you're ready to take that leap, make sure wherever you're getting this show, you upgrade, subscribe to the full network. And of course, if you want to go above and beyond, join us for awesome pro Q&As, options, oddities, a lot of exclusives, live streams, all sorts of fun giveaways. The optionsinsider.com/pro is the place to go to learn more as we learn who's joining us on the old European Market Brief this week. I'm pleased to welcome back on once again our old pal, Mr. Russell Rhoads, who's moonlighting over there at the Kelley School of Business when he's not out there talking all things vol. Mr. Rhoads, welcome back to the European Market Brief. Can you believe it's already episode 4, sir?
I can't believe it's episode 4 that it seems like we were just talking about this as a concept when I was over there for their conference in February. And lo and behold, we haven't even made it through the first half of the year, and we've already put 4 episodes together. And I can't help myself, Mark. We all love Caddyshack references. I'm starting to feel like Ted Knight's going to pop in at some point and ask me if I have a home, because I have been on the network so much lately.
Wow,
Don't you people have homes?
Ted Knight. Old school. Yes, old school. Wow, I haven't thought about that one in a while. Yes. So, well, on European Market Brief weeks, you get to do double duty out there. And it looks like our audience likes it. The chat's already getting going. They always like to talk vol, European or otherwise, Mr. Rhoads. But joining us on the old program this week, we have a duo of newcomers. First off, we are joined by Rex Jones. He is the VP of Product and Business Development over there at Eurex. Rex, welcome to the European Market Brief.
Thank you very much. It's great to be here.
And Rex, as we are wont to do with all of our first-timers, why don't you give our audience a bit of an overview of your background in the space as well as what you do day-to-day over there at Eurex?
Well, given my southern drawl, I'll give you the background that goes far enough back. I was born and raised in Louisiana and got deported to Germany due to family circumstances. And I decided to stay. Maybe it's a case of Stockholm syndrome that I fell in love with my kidnappers. But after finishing Goethe University here in the great city of Frankfurt, I decided to put my German language skills and my American background to work working for the European exchange, Eurex, and have been involved in a number of system developments, especially on the options side. One of my first projects was taking calls and puts trading to multi-leg strategy trading at Eurex. Now, this is almost 20 years ago. Today, it's pretty standard. About half of our options trade that way. And I've been guest to both asset classes that Eurex is dominant in. So I've worked on the fixed income side where I'm currently situated, but I've also spent some time in equity derivatives, having launched the V-Stock segment in Eurex with a relaunch in 2009 of the futures and the options following in 2010. So I've seen vol in different permutations. And there's more to trading than just symmetrical instruments like futures, even though that is my bread and butter business. At Eurex, I'm responsible for BOBL, SCHATZ, and BOBL futures, so the German rate segment, and also cover the options business within product and business development.
All right. And last but certainly not least, another newcomer joining us here on the network for the first time. He is James Sewell, the head of the multi-asset desk over there at Marex. James, welcome to the European Market Brief.
Thanks for having me.
And same question for you, sir. Give us a little bit of your background in the markets, as well as you're also the first person joining us from Marex. So give our audience a little bit of an overview. What do you folks do over there at Marex?
So me personally, I've always been based futures and options, so listed derivatives, mainly on rates. Various kind of institutions I've come through. I've been at Marex 18 months, based out of Dubai. But I've been in Dubai 12 years, so I'm not one of the newcomers that seems the influx we've had over the last couple of years. Marex as a firm is a lot bigger firm than I kind of realised till I joined. Recently listed on the NASDAQ. We've got centres across the globe, cover basically every asset class, commodities, equity desk, FX. We basically kind of a silent giant. My job is kind of covering mainly hedge funds, banks on the rate side, but also using the capabilities of Marex where they're strong to kind of help my clients if they need liquidity in different areas. Then I can kind of speak to the good desks at my company and kind of match them in.
I like that. The silent giant. All right. So with the team assembled, let's dive on into a Continental conversation.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have Continental Conversations.
All right, everybody, welcome to the Continental Conversation segment, the portion of the show where we explore a topic of interest to the Eurozone and these markets and how it might interest you in your own portfolios. And, the last few episodes, we've gone on some quests. We've gone on some fun journeys. Last time, we went in search of the elusive S&P 500 of the European markets. We're going to do that today, but in a little bit different market complex. We're going to go out to the rates complex instead. A lot of our listeners are familiar with many of our guests getting on the boat with the 10-year note, the 2-year, the 30-year. These are all products that you're all deeply familiar with. If you've listened to any of our other futures and futures options oriented program, they are also very large volume products. So the question for a lot of you listening to this especially those coming in from the US, might be what are some of the equivalents if you want to look across the pond and start looking at some European rates products to add to your portfolio. So let's start there. Rex, as the product guy here on the show, you're the perfect guy to tackle this for us. For our listeners who are maybe a little bit newer to the world of European rates, what are we talking about? What are some of the products we have out there for a lot of our listeners in the US? And why should they be intrigued by the European rates markets?
Liquid markets, strong benchmarks, solid underlyings, give you access to further diversify your investment, regardless if you're pursuing a pure alpha generating proprietary trading strategy, or if you're hedging any portfolio risk that you may have. And I think coming across the pond, crossing the Atlantic is always of interest, because that gives you the ability to tap into assets and into underlyings beyond what the United States has to offer. The big difference, I think, between the US market and the European rates markets in the sense of government bonds and the respective futures and options that trade in Eurex, at Eurex on government bonds, is surely the United States of America is one country, whereas the European Union is a union of different sovereign individual countries. So you'll have a homogeneous treasury market, where there's one issuer who does all of the issuance, to finance the needs of the United States of America's government. Whereas in Europe, you'll have individual nations, Germany, France, Italy, Spain, all with their own fiscal policies, all with their own financial needs, and also with their distinct bonds, and at Eurex, tradable, respective futures, and in many cases also options markets on these individual sovereign issuers.
Let's be very specific for the folks. Let's list the products we're talking about here. So we're talking the bund, the BOBL, STRs. Give us a quick rundown here, Rex.
In terms of futures and options on government bonds, the product setup is very similar to what you're accustomed to when trading treasury futures at the Merc or at the CBOT, to be more precise. We have bunds, BOBLs, and SCHATZ, which are just market terminology names for the different tenors in which the German government issues debt. Bunds is for 10-year debt, BOBLs is for Bundesobligation for 5-year debt, and SCHATZ is an abbreviation that is a term of endearment that you would call your honey, but it actually stands for Schatzanweisung, which is 2-year paper issued by the German government. We also have futures on Buchsels, which is 30-year paper, a little bit of different terminology. Functioning is the same, physically delivered futures contracts. I think the big distinction towards the US versions is we don't have delivery months here. We have actual delivery dates, which is the 10th of the quarterly cycle. So we just had our futures expiry for the June contracts. Everybody's trading September contracts now. September 25 expiry. It'll go out of play on September the 10th, where if you're long of futures, you will be taking physical delivery of the underlying bond in the delivery basket.
And just keep it on the product scene for a second for our listeners. They want to know exactly how they can engage with this. What trading hours are we talking about for these?
Central European times are 1 a.m. to 10 p.m., so -7 hours. That would put you then in Chicago. So basically, you can start trading the day before. So that would put you at 6 p.m. Chicago time this evening. Then you'd be trading tomorrow's market then, and then respectively 10 o'clock is in -7 hours again, so until 3 p.m. So you have the whole night to trade and the whole morning and early afternoon.
We can effectively time travel trading these products. I like it. So there you go, adding an extra layer of fun to these products. James, same questions for you. Again, a lot of our listeners are based here in the U.S. Maybe they don't follow the European rates markets day to day, which is why they're tuning in to a show like this. When you're talking to a lot of the end users out there, what are some of the use cases people are putting these European rates products to?
So I think Rex covered it pretty well there. Basically, all the products are standard kind of versus the US equivalent. So SCHATZ is just the German equivalent of the US 2s. Something like a ESTR is the equivalent of your SOFR contract. All of this stuff, it's just kind of regional to us. But as Rex pointed out, we've got kind of different countries of similar. So we have a lot of people that will trade different rate curves. So it might be a German rate curve versus Italian or French, or sometimes for your kind of listeners, there's a lot of people now trading like US versus different. So today it's kind of been a lot of German long end versus the US long end. So it's people kind of trying to trade discrepancies there. So that's what I'm seeing from a lot more US clients. As you know, like most people, most funds now are macro. They've got exposure everywhere. So that's where kind of the European stuff comes in. These mainly hedging tools for different underlyings or cash positions or swaps positions. But now, in the old days, fixed income was the kind of slow-moving safe net. Now it's the majority speculative. So it's people making bets on which way kind of the European Union will go, where rates are going to move in the next kind of six months, year, 2 years. And then obviously you've got all the nuances per country, the economics, the supply kind of dynamics. That's what people trade.
Yeah, you're right. The perspective on rates has certainly changed for a lot of people in the last few years. Used to be if you managed a rates portfolio, it was kind of sleepy, kind of low risk. It was your grandmother's risk-free portfolio or pretty close to it. And of the last few years, we've all seen that the rates complex can move when the winds take it. And a lot of interesting things, maybe some frustrating things can happen out there as well. So rates a little bit more active, perhaps a little bit, dare I say it, sexier than some people may have assumed when they first started learning about rates. Speaking of learning about rates, Mr. Rhoads, similar question for you, sir. Looking at the European fixed income landscape versus what a lot of our listeners are traditionally familiar with here in the U.S., you know, your 2-year, your 10-year, your 30-year, your traditional rates complex. What are some of the similarities and differences you see? And for, you know, a U.S.-based listener out there, where do you think these European products, where do they slot into a portfolio, sir?
The great about the timing of today is last night. Can you think of anything better in the world to do than take derivatives in the summertime? But I teach derivatives in the summertime, and
you got an exciting summer on your hands, sir.
Last night was all about bond futures, so I felt like the timing of this worked out quite well. You know from the other programs that I'm absolutely obsessed with what the next Fed move is going to be, what's being priced in by the markets, and it just got mentioned in passing. I didn't realize how different they tend to trend together, but how different the anticipation is between the two markets around. You always hear the talking heads talk about how we're going to see all the big central banks are either cutting kind of in sync with each other or raising rates in sync with each other. I was just digging around as to what has been showing up in the version of what I talk about in the U.S. all the time, which is what's going to happen next with the Fed. And there was a big divergence at the beginning of this year. If you take a look at the September meetings for the two different, the region and the U.S., at the beginning of the year, it looked like they were pricing in maybe 6 rate cuts by the September meeting in Europe, and they were pricing in 2 here. And now they're not pricing in 1 by the September meeting, as far as what I could tell. And you guys can correct me on this because I'm not an expert in that market at all. I'm just reading what I see on my Bloomberg. But it looks like it was a more rapid drop in expectations for European rates relative to U.S. rates. And the other thing is I'm mostly equities, and I've been doing a lot of work on the EUROSTOXX 50 versus the S&P 500 and V stocks versus VIX. I think there's some things that I'm going to be doing some digging in with respect to the European rate market versus the U.S. rate market as well. And in fact, I kind of regret that I haven't been doing that in the past when I look at the liquidity of both markets and how much they overlap time-wise as well.
Let's hit on that a little bit. The liquidity, as you just mentioned there. Obviously, when we talk rates in the U.S. here, you're hard-pressed to find a deeper, more liquid complex out there when we're doing our futures rundown program 99 times out of 100, we have the 10-year topping that list on the futures side. On the options front, the 10-year is a beast, 30-year, all these products put up just a mountain of volume on a daily basis out there. So for a lot of our listeners looking at the European rates complex through the lens of the U.S., how do they stack up from a liquidity perspective?
The fixed income markets in the U.S. are as liquid as it gets. And the European counterparts are right there in line with them. In fact, you say that the 10-year typically is topping the list of volume when we talk about the U.S. options on futures. Right now, and I know Europe's been open a little bit longer, but right now both the Eurobond and the 10-year have traded. I got to get my commas in there. Traded over 1 million contracts each, which when you talk about the notional size of each of those contracts, that is an incredible amount of market activity. And I don't think we're actually talking about a very volatile day as well. So the liquidity, and it's really interesting when you look at different regions around the world. It appears that APAC doesn't do a whole lot in these markets, but Europe and the U.S., they're more heavily traded than the equity index futures markets, which is where a lot of people look to get their volatility and their action. And I think they need to be looking at both of these markets as well, and these markets together as well.
James, same question for you, sir. As you're looking at the European rates complex through the lens of the U.S. products, which you already established are pretty deep and liquid. From your perspective, how do the European offerings, how do they stack up?
It's funny seeing both sides of kind of how we view it, because most people in Europe envy the liquidity the US get. So it's still US Treasuries is the deepest market. You see big block trades going through it every day that don't even flinch the market. I think the kind of biggest one we look at when we look at options, if I'm doing a Bund option, you're kind of hoping to get a one tick wide market. And in treasuries, it's always one tick, and it can be in up to 500,000 contracts. Like the liquidity in the US is crazy, but Germany's also pretty good, and it kind of gets lower the kind of smaller countries you get. So Italy's a bit less. France is probably slightly better than Italy.
You're saying the Italian rates market can't hang with the US 10-year? I'm shocked.
No, yeah, exactly. Like 5,000 blocks of TYs kind of no one even notices. If that went through in Italy, people would be going wild.
My Italian brethren, they can't hang a candle to the 10-year in the U.S. We're shocked and appalled. Rex, the same question for you, sir. As you're looking at it through the lens of the U.S. markets, how do you compare and contrast these two market segments, sir?
Notionals are very similar, $100,000 for Treasury futures, 100,000 euros for Bund BOBL SCHATZ futures, and the respective other markets, BTPs for Italy, OATs for France. Traded volumes we've talked about. Risk capacity, I think, is also something that traders should look at before engaging in the market. What's quoted on the inside market? What kind of sizes am I seeing there? How shaky are the prices? How do they react to incoming order flow? We try to systematically display that, to be able to make average statements. On average, if we're in a 6% vol regime for Bunds, you're probably going to see 500 contracts quoted on the best bid offer price at one tick throughout the trading day. Maybe not necessarily at 1 o'clock in the morning, but surely when the cash market kicks in at 8 a.m. in Central European time, so 1 a.m. for Chicago. Nothing to add to James's comments regarding the options market. I think in general, we also look at, risk capacity and futures volumes in relation to the underlying bond markets and the underlying amount of government bond debt. So, if we wanted to make a comparison between the United States and Italy, it would surely be the debt to GDP ratio is very similar. However, in overall figures, 34 trillion in the States dwarfs the 3 trillion euros that Italy has in outstanding debt. And other things that we'll look at is, for example, the futures volume in relation to that outstanding debt. So what we see, for example, in Bunds is that it outpaces the underlying volumes in cash bond secondary market trading by a ratio of 10 to 1. Why is that the case? Because many European investors from other, let's say, national markets that have a very high price correlation to bunds will turn to our futures product as a proxy hedge because the correlation is 98 as it is. So investors who hold Dutch bonds, Austrian bonds, their Finnish bonds, they're all very comfortable using Bund futures as a hedge, and hence liquidity benefits from that. And anybody looking to trade the market will then benefit from that additional liquidity that each of these futures is able to congregate.
Russell, Rex kind of laid it out earlier, the maturities. We're used to here, going down the yield curve, 2-year, 5-year, 10-year, 30-year, all that fun. When we're looking at the different terms over there, in the Eurozone, what are we talking about? And if you're, let's say, a typical retail listener, even if you're a fund out there looking to dip your toes into these waters, where should they start lining up their opportunities, sir?
With respect to the U.S. market, I'd say the 10-year, and I think the Eurobond would be the one that you would want to take a look at just for liquidity purposes. Something that was mentioned, and I want feedback if I'm off the mark on this one, but it does appear that there's more volume relative to open interest in some of these European products relative to U.S. products, which makes me wonder if, and I think I did hear in passing someone say that there may be a little bit more speculative activity in the European fixed income futures versus the U.S. fixed income futures, just because you have, again, more trading as a percentage of open interest, which I always equate with people like myself that'll open up and close a position during the, over the course of, the same day. And then just something that, and if either of the other guys want to chime in on this one, one of the things that I talk about when I'm emphasizing Eurostoxx 50 is that you get this market close at a period of time that's usually pretty quiet in the U.S. And around the equity market closes, you do have a little bit of excess volatility and more volume. And I just wonder if that's the same for those markets where, and I always feel like in the U.S., we all start getting bored about 10:30 or 11. If it's a Friday in the summer, they put golf on one of the monitors at the exchanges. So I just wonder if it's an opportunity for those that like to trade, having an extra close every morning during, mid-morning in the U.S. during the day.
James or Rex, anything to add on that? The notion of, as he puts it, having an extra close to trade, keep your interest at least?
Well, I was going to say that I agree. It tends after kind of as the Europe and UK go home, it quietens down a bit. But it seems Trump's timing his tweets just as we're driving home, which I've had a few times, trying to message in and getting a load of my phone lighting up. So it's kind of been different the last couple of months. But yeah, the thing with kind of, especially European market, especially something like Bund, which is the German 10-year, that starts at 1 a.m. London. So it's not far off 24 hours. So there's lulls in it. Asia's obviously not as kind of busy as it is around European time, and we get busier around economic releases, supply. So yeah, I think for our perspective, there are peaks and troughs of volume. It just depends how busy the slate is on the day.
I think we're all struggling to come to grips with the Trump tweet schedule. They can come at any time, James. And
it seems.
Exactly. So yeah, there's a lot to grapple with. We were joking at the start of the year that we're all living back in that world where a single tweet can change the markets, can change vol, and that's pretty much what we're seeing yet again out there. Rex, anything to add, sir?
Yeah, Mr. Rhoads had made the comment about open interest and its relationship to volume. I think, there is one distinct difference that I've been observing probably over the last year or year and a half between the U.S. markets. I think generally in fixed income, we can take back a step, open up our textbooks and say, well, there's this triangulation of liquidity going on in the market at any given time. You have the futures market, you have the repurchase market in which cash bonds are borrowed and lent out over 2 days, 3 days, or what have you. And that repo rate kind of drives the futures prices. And then you, of course, have the cash bond market with its secondary trading activities. And we've seen a surge in open interest, especially in the US markets, but also in the SCHATZ and in the bubble markets, where open interest is actually twice the amount, not in basis point value terms, not in duration terms, but just the sheer number of futures. 2 million contracts open interest in SCHATZ on 2-year futures at Eurex, round about 1 million contracts. So the ratio itself, it kind of also depends on what's going on in the background in terms of the attractiveness of the basis trade that many professional investors have been pursuing. It's come to our knowledge that in the United States, asset managers tend to be long futures as a surrogate for actually taking money and putting it into the cash market. So using the leverage inherent in these contracts, because they're not that volatile in the sense that the margin that Eurex will charge on an initial margin basis is around about 3%. Give or take, depending on which level we're at. So hedge funds have stepped in and mostly taking the short position at the CME in the Treasury futures complex, and then repoing that risk out. So there's a very high amount of open interest that's inherent in the market to service the institutional flow. We see a good deal of basis trading in Europe as well, yet because there's less of a regulatory necessity in terms of capital requirements and how that's accredited to asset managers, not quite in the same dimensions. So the ratios themselves are always important to observe, to draw conclusions. Is this a day trading product? Is this a more buy and hold and hedging product? But it's not the only thing out there that we need to keep in mind.
A lot of our listeners might be familiar with LIBOR. Of course, that has gone the way of the dodo now. We are living in a world of EURIBOR and then some other products out there with different flavors like the 3-month EUROSTR futures. A lot of our listeners from some of our other programs are familiar, of course, with 3-month SOFR. There's been a lot of shakeup, a lot of change up in the European rates complex over the last few years. So Russell, you get the unenviable job of explaining all of that to our audience, sir. A big shakeup going on, LIBOR going the way of the dodo. We got 3-month EUROSTR futures. We've got 3-month SOFR over here. I'll break it all down for us, sir.
It's about 10 minutes. I'm going to give you the abbreviated. So there were nefarious things going on with LIBOR. I wish I could remember the book that I read about it. Some guy who was bullying everybody on the LIBOR, and he made a sell side coverage pay for his honeymoon and a bunch of other things. It was a pretty comical situation there. But the thing with the LIBOR rate, it was done by a survey, and what you really you remember pit settlement, Mark, where you might want to settle things in your favor, et cetera, every once in a while, and that opened up the element of that possibly happening sometimes. Now in both markets, what we get is a rate that is based on people putting money to work, excuse me. And I think, there's a lot that just takes all of the questioning about where did that rate come from away, and creates an environment where there's no questioning as to where that number came from. So but the one thing that's a little unusual is different regions seem to have settled on different types of rates. SOFR is the one in the US. And they've got a couple over in Europe that are very similar to short-term rate that have the futures trading on them, much like we had the Eurodollar futures forever. Now we've got the SOFR futures over here. So that's kind of at a very, very high level how we got to where we are now. And I'm going to go ahead and just be very angry. I got the new Hull derivatives book, and he hasn't updated that yet. And the whole reason I got it was because I thought, all right, they've made the change.
He's still talking about LIBOR in his book?
A textbook that has 13 editions and retire.
Yeah, a little dated there. But you're right. There were a lot of problems and issues. I don't see how, like a pit type settlement, Mr. Rhoads, how that could open things up to the probability of manipulation. I fail to see how someone would want to settle something in a way that is favorable to their book and unfavorable is something else. I completely don't understand what you're laying down there. Our chat is listening there. One of Nichols asking, wasn't LIBOR really shady? Yeah, there were a lot of issues with it, as Mr. Rhoads just pointed out. The settlement alleged to have been manipulated, so that hence going the way of the dodo. And now we're all moving on to the world of Euribor. Speaking of new products, James, as you're looking at the landscape out there on the European rate side, talking to your clients, is there anything that you see that, or maybe they're asking for, that is missing right now? Maybe a duration that isn't available that maybe they would like to see?
The problem is there's a few people kind of always ask for, and then I think Eurex try to list it and then no one trades it. It's something like Italy. Italy only has a 2-year and 10-year. So you kind of miss a big gap in the middle.
You keep picking on Italy, James. I don't know. I'm sensing. But
then I'll target France, because France only have a 10-year and the UK only have a 10-year as well. So there's less chance of us to trade kind of curve trades like you have the optionality in the US, where you've got multiple different durations. So there is a gap there, but I think Eurex have tried these ones a couple of times and they just kind of haven't taken off. So most people kind of generally trade 10-year anyway, of whatever country. Italy, France, Germany a bit more kind of curves, but I don't think that's going to come soon. More people are looking at the Eurobond. I think Eurex listings at September that starts.
Yes, it is.
It is. So I think ICE have tried to go quickly and hasn't taken off. So that's people are asking about that. Still a bit early. I think there'll be a lot more flow once Eurex kind of lists their ticker in September. But that's the only one people are kind of asking about at the moment.
James, I'll have to keep an eye on you. I'll have to get offended on behalf of my paisans across the pond there. You keep slamming Italy. So I'm going to keep an eye on you, Mr. James, as we keep rolling. Rex, Russell did his able best to explain all the madness around Euribor and all the fun that unfolded there. But also, as a result, you folks over there at Eurex adding some more short-term products to the rates complex, your short-term euro interest rate futures. Break those down for us. Why did you add them, and what can you trade over there?
Currently, we still have the heritage products that are based on the Euribor rate. The Euribor rate has yet to be formally decommissioned, as was done in the United States with the dollar LIBOR rate, as was done in the UK with the British pound sterling LIBOR rate, as was done in Switzerland. And I think the Europeans are still waiting for this formal decommission to actually take place. At the same time, the ECB has published a rate out of the repo market that's an overnight indexed rate that goes under the name of the 3-month EUROSTR. And we are currently battling it out with another European exchange to establish the biggest and best liquidity pool there. STIRS, short-term interest rate products, are always the shortest end of the curve. We have 3-month expiries there, ranging out for the first 5 years. Why do people treat these? They're almost more precise if it comes to just taking a global macro view on the rate path of any given central bank. If you're looking at something like SCHATZ, you'd say, it's underlying as a 2-year government bond. However, the LIBOR curve, the SOFR curve is, it has a different risk element to it. It's not government bond risk, it's interbank risk of lending money for a certain period of time, for 3 months in this case. And, the curve trading strategies, the finesse that you can bring in into pinpointing the precise path of how you think Powell's going to act with SOFR options, or how you think Lagarde is going to act over the next 6 to 12 months is just key to these products, and that's why they're so popular. But in absence of a formal decommissioning of Euribor, Eurex is offering both of these products side by side and has established liquidity and open interest in both of these, both Euribor and in 3-month Ester.
Well, Russell, I do believe you have dug up the book you were referring to earlier, so if you want to share that with our listeners, have at it. And then also, as we're looking at the rates complex across the pond, and a lot of our listeners, obviously very option-centric, if they're considering some option strategies they might want to employ out there, what are you looking at in terms of option strats that are popular on the European rate scene, sir?
The long title of the book, The Spider Network, the wild story of a math genius, a gang of backstabbing bankers, and one of the greatest scams in financial history. I tried to avoid using that word scam before. I tried to say it at a very, I was trying to cushion it, and I was putting my hat on like I used to work for an exchange there for a second, just to make sure I didn't say anything that was over the top about that one. Strategies, and the other guys would see the flows, pay more attention to the flows than I would, but the strategies, from what I could tell, seem to be somewhat the same. The implied volatility of the option market and again, I'm sticking with the boon because that's the big one. They seem to be very similar markets as far as the amount of realized and implied volatility and just the behavior of the market. So I think you would use pretty similar approaches. I don't know if what was mentioned as the higher open interest in the U.S.-centric markets making some strategies and maybe some longer-term strategies a bit more popular if they're being used like that in a portfolio management context. But I feel like you would approach both markets somewhat similarly. I did trade Bund futures over a decade ago, and I had a 10-year breakout system and a Bund breakout system, and the Bund system actually worked a bit better. So, and I never understood fully why, but it did seem to work better for me. It might have been the timing of when I was doing that as well.
You were saying that last week with V stocks too. So it seems like your strategies work better on their European equivalents than they do on the U.S. versions.
I'm following my fellow Southerner Rex over to Germany.
There you go.
I'm just going to start trading over there.
Really quickly, because we are coming up against it, but we're having such a good time just talking in the rates complex. James, same question for you really quickly. You're engaging day to day with a lot of clients and end users. What are you seeing in terms of use cases and some common and popular option strategies that people like to employ on the European rate side?
I think we alluded to it earlier, where Europe's taken a march on kind of rate cuts and the cutting cycle. So now it's trying to pinpoint, is it going to be one? Is there going to be two? When is it going to be? So that's the main kind of themes at the moment, in especially Euribor options. So we've seen a lot of kind of leverage structures looking for an extra cut in the future. That's the general theme over the last couple of weeks I've noticed. Also, a lot of people have kind of white vol, which is like the shortest part of the curve. So rate expectations a year in, we've seen that market, the vol, just kind of getting decimated, where the curve, we're getting so close now to terminal, or people's perceived view of terminal. So that people were selling a lot of vol on them kind of areas. We've started to see people buy it now where it's been crushed so much, and also buying it whites versus reds. Reds is like the 1 to 2 year segment. So that's the main kind of flow I've seen over the last few weeks. We're getting into the summertime, so it's quieting down a bit. The only thing that's kind of picked it up is the threat of nuclear war over the last couple of days. So that's woke everyone up.
All right. Got to leave it there now as we keep on rolling and get into a little bit of activity. It is time to check in with the overnight desk.
What's lighting up the tape in the European derivatives markets right now? Let's find out. It's time to check in with the overnight desk.
All right, everybody, welcome to the overnight desk, where we look at some interesting trading activity that's lighting up our tapes. Might be interesting to you. James, since you just hit on it, let's kind of start there. We've been kind of touching on this theme a few times now throughout the show, which is this disparity right now between the European rate scene and the U.S. rate scene. We just had Powell and company meeting recently here again, kind of reiterating that they say they're on board with a couple of rate cuts, but they've been saying that for a couple of years now and haven't really materialized much on the rate cut scene. Meanwhile, go across the pond and the ECB hasn't met a rate cut it doesn't like. They are aggressively easing over there, while the U.S. we're still very much fixated on inflation and the possible ramifications therein. And so as a result, a lot tighter over here. I'm hard pressed to think in recent memory where we have such a sharp dichotomy between the European rate scene and the US rate scene, both moving seemingly in different directions, at least for right now. So that sets up for a lot of our listeners a lot of interesting trading opportunities. James, you kind of touched on it earlier, but we can get a little deeper now into some of the flow you're seeing out there right now. Again, this dichotomy makes for some interesting trading markets, some interesting trading opportunities. Are you seeing any interesting setups, any interesting trades going up to try to take advantage of this?
Well, it's interesting because at the moment we've definitely got the disparity between the two regions, and especially US, where you've got Powell kind of consistently straight back, keep it as it is. We don't really know how all these tariff flip-flops are going to kind of feed in. And then you've got Trump every other day sending a tweet saying, just cut 2 points now. So, yes, it's difficult for people to trade that narrative. We did see some interesting flow going through. There was some big curve trades going through in the US, and a few people were speculating that was the end of Powell's term. So if Trump could get someone that he's more favorable, they were looking for kind of accelerated cuts past where Powell would leave. So that was interesting last week. Generally, apart from that, it's I think the Fed have been on hold the last few. The curves pricing a lot more in them. A lot of people are expecting. And as you said, they've got catch up to do with the ECB. So it's an interesting curve to kind of trade, but it seems cuts just continually keep being priced out. So I think that's what most people are looking at the moment and trading around that narrative.
That's true. That's an additional wrinkle to add to it, not just the dichotomy between the ECB and Powell and company, but also you have Trump, who's on a much more similar page to the ECB. He wants cuts and he wants them now. So yeah, 3 different moving items here to keep track of if you're looking at the rate scene right now. Rex, same question for you. You've been around in the rates game on the European side longer than I. Can you recall off the top of your head another similar period like this where we had such a stark difference and divergence between the US rate scene and the European rate scene? And as a result of this very, very stark divergence, what kind of interesting trading activity and setups are you seeing out there?
Well, from the exchange side, I don't really have the liberty to take my own opinion. You know, we operate the marketplace. We try to congregate as much liquidity as possible. So going into observation mode there was a time pre-COVID in the years 18 and 19 when the U.S. went into a full rate hike cycle, while Draghi at that point in time was sitting on the fence and, you know, waiting for more conclusive economic data to come in to strengthen their position. And before you knew it, we had the lockdowns and the responses of endless money supply and negative rates. And for a very long time, Europe also had negative rates because it was battling the contagion risk of, you know, the Greek crisis, and, you know, with states like Italy and Spain really suffering with very wide spreads to the German benchmark, just as a sign of, you know, their fiscal policy and, you know, out of control debt, to, you know, put it mildly, that then, you know, ultimately led to, you know, a write-off of a good deal of Greek debt. Today, things are different, right? I mean, 2020, you know, surely changed a lot. Since 2022, we're back in positive rates territory. But the most striking thing that we've seen people engage on in the last 6 months, besides, you know, your regular flow of systematically selling volatility, as Mr. Rhoads pointed out, because there's a difference between implied volatility and realized volatility, everybody's favorite strategy of picking up nickels or dimes in front of a steamroller and hopefully getting out of harm's way when things do spike. We clearly see about 20% of our volume attributed to trades like that. It's a systematic shorting of volatility. Besides that, you know, you can use your trend following models from the futures and then go into call spreads, put spreads, you know, besides your global macro positioning, you know, looking for technical features to then, you know, kind of intrigue you into a trade and to display that premium efficiently with options. That's kind of the general noise of you know, daily volume of 150,000 Bund options that we'll typically see. But to make the point, correlation correlations between treasuries and bonds have more recently broken down. If you would have asked us 9 months ago, I would have said correlation between TYs and bonds is north of 85. Today, I'd be pressed to put a number of 50 on that. So, when bond futures go up, it doesn't mean that treasury futures are going to go up in the same amount. And that, of course, then opens up spread trading opportunities beyond the yield curve play, beyond the different European sovereign segments that we see a lot of trading in. So then, for real opportunity, is it going to be a conversion back to what it was of 85 correlation? Is it going to stay where it is? It's like there's a new game in town, and that's distinctively trading the differences and nuances between the US and the European curves.
Ah, yes, the Greek debt drum. I was joking about our friends in Italy earlier, but our friends in Greece can also drive some action in the rates complex every now and then. Russell, same question for you, sir. Your thoughts on this a relatively stark policy divergence we're seeing right now between the ECB and the US. If you have any thoughts on the historical context, Greek related or not, have at it. And then B, any interesting flows or trades you're seeing going up to take advantage of this, sir?
Definitely want to point out is I think you insulted the Italians more than anybody else comparing them to the Greeks. I don't think they like that.
I'm allowed to, though, as a fellow Paisan.
All the regional stuff over there, but I don't think I don't think you're making friends, Mark. You may I don't know if you're one of those guys that qualifies for an Italian passport, but they may yank it from you.
We're huge in Italy. Huge in Italy, sir.
So, when I do the option program with you, I take a look at, how the skew kind of shifts in different markets. It does, surprising, and just because I know there are people listening that don't trade bond futures very much, just remember that when rates go up, the bond future prices go down. So if somebody's buying puts on bond futures, they actually think that rates are going to go up or at least not go down like people thought they were. That's a lot of put activity today. And I don't know if that's related to World War III coming to an end yesterday or not. I'm really not 100% certain, but it does look like, and it does look like that market is kind of primed to break in one direction or another. I don't think all of a sudden we're going to be expecting rate hikes, but it looks like there is some protection out there against the possibility of the Bund going lower in the near term or over the course of the summer.
And let's get specific beyond just the rates dichotomy here in the US versus Europe. Very specific to the Bund over there in Germany. Rex, we're seeing plans for a massive spending bill, a massive infrastructure bill on the order of $500 billion, which is enormous over there. Those types of enormous fiscal moves tend to impact the rates complex over there. So, Rex, what are you seeing on the Bund side as a result of the plans for this massive amount of fiscal spending over there in Germany?
Well, just the announcement on March the 3rd by the then still to be confirmed and elected German Chancellor Friedrich Merz caused a 30 basis point spike in the Bund market on that day. And, as this continues to be confirmed, I'd say we're still in elevated volatility territory. Usually you would say rates volatility on the 10-year trades in a corridor between 4 and 6%. And then, if something dramatic happens, it'll spike up to 10, 12, if not 14% at maximum. And then there's kind of this, mean reversion trend where it tends to go back down. It seems that now, even though the summer is coming into effect and people are going to start going to Sardinia on vacation, nonetheless, we're still trading 6.5%, 7% vol in the market. Look, generally, more inventory is good as long as it's not too much debt that would, in some way fracture the confidence that investors have with any given issuer. More inventory means more hedging, better rolls, better basis trading opportunities in the futures. And the price action has surely benefited us in terms of volatility, but also in terms of volume.
Well, we are coming up against it. It's been a fascinating conversation. So let's go around the horn for each of you one last time. If you have any last activity you're noticing that maybe you want to share with our audience, have at it. And as we're looking ahead to the rates complex for the rest of 2025, what are some interesting potential trading opportunities or maybe some volume catalyst people should be keeping an eye on? James, we'll start with you, sir.
Yeah, well, I think the man for the volatility has been Trump, and he will continue to be. So I think at the moment, people are still trading. Is it tariffs or is it taco? What's going to happen next with tariffs? It's kind of gone a bit quiet. That was our volatility in kind of Q1. So if he wakes up the wrong side of the bed one day, then we're going to be back kind of trading those tweets. Away from that, it's what the next part of this kind of war takes us. At the moment, it seems ceasefire, which quickly seemed like it was coming and going today. That again, it's following headlines. 1 minute, Trump's announcing a ceasefire. Next thing, Israel is sending bombers over. Next thing, Trump's calling them back. That's going to be the theme for the next kind of few weeks, maybe months, especially. And it seems to get exaggerated in the summer where people are in Sardinia, even though the hedge fund guys are generally trading from Sardinia when they're away. So that might kind of keep the market going. But I think Trump's where the focus is at the moment. There's going to be other kind of more regional things people look at. I think maybe the politics will come back to a fore with the far right, as you kind of focused on the spending, with Trump kind of pushing everyone to get military spending up, and not many governments at the moment have much money to spend. That's going to be interesting how that kind of feeds through. So yeah, there's a lot of narratives floating around. Which one's the next vote will be the next big mover? It just depends how the kind of tide turns, I guess.
You're right. It's kind of hard to look too far ahead when we're living in a tweet-by-tweet market as it is. You're right. So Russell, same question for you, sir. Any last activity you want to share with the folks, have at it. And then B, if you can look past the tweet storm of the moment and look down the road a little bit and see what other catalysts you're keeping an eye on in the European rate space, have at it, sir.
Everywhere. It's just inflation related to, war is not something that generally results in lower inflation. And everybody's waiting for the tariffs to kick in and see what the ultimate result's going to be in various developed economies. Are prices actually going to go up? We know what everybody says is going to happen, but we want to start seeing the numbers. So I'd be paying very, very close attention to any consumer price index numbers at significant parts of the world that are coming out, and producer price. It may show up in the PPI first. So maybe pay attention to any inflation numbers that are coming out, but maybe from the producer side, that's where it may show up first, if it's actually going to happen. My assumption is these markets are going to be very braced when we get these announcements over the next few months.
And Rex, the last word is yours, sir, on this topic. Any potential catalysts you think folks should keep an eye on in the European rates complex? Have at it, sir.
Look out for regional differences. Look out for inflation drivers that are specific to certain areas. Closing off a strait in the Persian Gulf has a distinctively different impact on European economies than it does on other regions due to gas imports, oil imports, whereas the U.S. is a net exporter of energy, for example. So where there's crisis, there's also opportunity, and I hope that we as a marketplace are able to service that opportunity with liquidity, regardless if it's Liberation Day, regardless if it's March the 3rd, where Germany makes such an announcement and vol hikes up. We hope to have the marketplace ready for you to service your liquidity demands, no matter how high or low the tide goes on you.
All right, and that is going to do it for us here on the European Market Brief. Thanks to everyone who sent in questions. No time for the red phone segment today. We'll get to them again on future shows. Seems like our live listeners are having a great time. They're saying, great show. You guys are making European rates market interesting. Well, thank you. We try. That is the point of the show at the end of the day. But before we go, let's go around the horn one last time and check in with everybody. James, we'll start with you, sir. If folks are intrigued by what they're hearing here and they want to know more about the European rate scene, maybe know more about Marex, where should they go? What should they do?
Anyone who's on Bloomberg can find me on there. I'm also on LinkedIn. I put some ideas and thoughts on there. So that's how generally most people follow.
There we go. And Mr. Rhoads, same question for you, sir. If folks have more questions after listening to this, they want to reach out to you, or maybe they want to check out any of the analysis you're currently working on, where should they go? What should they do?
So Friday, I'm bringing another person on to help me with some of the analysis, and they are more focused on, I'm using they because I'm got to keep it very confidential for the moment, because they haven't told anybody what they're getting ready to do, but they their dissertation was on the carry trade, and they're very focused on international markets, which complements me an awful lot. So in the very near future, after June 30th, when they can actually talk about it, I'm going to be bringing somebody on to help me with doing some more deep analysis as opposed to the superficial stuff that I have been doing.
Oh, expanding the team on the international front.
Yeah.
That'll be interesting.
When banks are letting people go, it's easy to expand the team.
You're scooping them all up. Well, there we go. Mr. Rhoads, add into the teams. That should be interesting, and more European and international flavors. That should be fun on future episodes of the European Market Brief. And last but not least, Mr. Rex, if folks are intrigued by everything we're talking about here, maybe they want to know a little bit more about all things European rates derivatives, where should they go? What should they do, sir?
Well, please go to Eurex.com. If not, reach out to me on Bloomberg. If not, reach out to me on LinkedIn. Check out some of the systematic evaluation of trading strategies that we've published over the years. We've looked at the steamroller strategy. We have a systematic short vol. We've done that for different strategies. You want to do it with straddles, strangles, or with call flies, you need to do your homework to be able to do that systematically. It's less about a one-off trade and getting lucky. We hope that people take the time and put in the effort, put in the miles to systematically think about how they want to structure their trades. And, so it's not a one-off, so you can, be successful more than once, again and again, come back for more.
I like that. The steamroller strategy. I like the name. If you want to check out all that for yourselves and a lot more, you can go deep into all things European rates, listeners. A lot of products there for you. Eurex.com, EUREX.com, the place to go to begin your journey. That's going to do it for us on episode 4 of the European Market Brief. Also going to do it for us on the network today. Back again tomorrow with a triple header, not just a double header, but a triple header, double header of Options Bootcamp, followed by the futures rundown. What's lighting it up in the world of futures? Probably some rates coming on that show, so stay tuned for that. Thursday, of course, our usual double header of the option block, as well as This Week in Futures Options, which again, we'll invariably touch on rates in some capacity. Friday, of course, I'll be joined once again by our good buddy, Mr. Rhoads, to talk all things vol on volatility views. Then we're back, and actually another special guest who will also be joining me for Options Oddities immediately after vol views. So if you want to check that out, only place to get that, theoptionsinsider.com/pro. Trust me, it's going to be a good one. A lot of unusual activity on the docket for this week. Then we're back again pretty soon with another great episode of the European Market Brief. Stay safe out there, everybody.
The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Eurostocks, V-Stocks, DAX, and European rates derivatives like the Bund, BOBL, and SCHATZ, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.